Imagine waking up one morning and discovering that everything costs just a little bit more than it did yesterday. Your bus ticket is slightly more expensive. Your favorite snack costs a bit more. The rent you pay increases at the end of the year. None of these changes seem dramatic on their own, but over time they add up. That quiet, steady rise in prices across an entire economy is called inflation. It is one of the most important ideas in economics. Yet it affects ordinary people in very ordinary ways. At its core, inflation means a general increase in prices over time. The word general is very important. If the price of one product goes up because of a temporary shortage, that alone is not inflation. Inflation occurs when many goods and services become more expensive at the same time and continue rising over months or years. When inflation happens, the purchasing power of money falls. Purchasing power simply means how much you can buy with a certain amount of money. If you could buy 3 items with $20 last year but only 2 items with the same $20 today, your money has lost purchasing power. To understand this more clearly, imagine a simple situation. Suppose in a small town there are 1,000 loaves of bread available each week. The people in the town collectively have just enough money to buy those 1,000 loaves at $2 each. Everything is balanced. Now imagine that suddenly everyone in town receives extra income. They now have more money in their pockets. But the number of loaves of bread remains 1,000. Because people have more money and still want bread, they are willing to pay more. Bakers notice that customers are competing to buy bread, so they raise the price to $3. The bread did not change. The amount of bread did not increase. What changed was the amount of money chasing the same goods. This is one of the simplest ways to understand inflation. Economists often explain inflation through 2 major forces, demand and supply. When demand for goods and services increases faster than supply can keep up, prices tend to rise. This is called demand pull inflation. It usually happens when an economy is growing quickly. People are earning more, businesses are expanding, and consumers feel confident. They spend more money on cars, electronics, vacations, and houses. If companies cannot increase production quickly enough to meet that demand, they raise prices. In this case, inflation is driven by strong economic activity. On the other hand, inflation can also come from the supply side. This is known as cost-push inflation. It occurs when the cost of producing goods and services increases. For example, if oil prices rise sharply, transportation becomes more expensive. Since many industries rely on transportation, their costs go up. If wages increase significantly, companies must pay more to their workers. If raw materials become scarce, manufacturers must spend more to obtain them. To protect their profits, businesses pass these higher costs on to consumers in the form of higher prices. In this situation, inflation is not driven by excessive demand, but by rising production costs. Another important factor behind inflation is the money supply. Money, like any other good, follows the basic principle of supply and demand. When the supply of money increases much faster than the supply of goods and services, the value of money can decrease. Think of money as a tool for exchanging goods. If there is too much of this tool compared to what is available to buy, each unit of money becomes less valuable. Governments and central banks have the authority to create money, especially in modern financial systems. If they create too much money too quickly without a matching increase in production, inflation can follow. Inflation is usually measured using price indexes. One of the most common methods is the Consumer Price Index, which tracks the prices of a representative basket of goods and services that households typically purchase. This basket includes items such as food, housing, clothing, transportation, healthcare, and entertainment. By comparing the cost of this basket over time, economists can calculate the rate at which prices are increasing. If the basket costs 100 units of currency this year and 105 units next year, the inflation rate is 5%. It is important to recognize that inflation does not mean every single price rises at the same rate. Some prices may increase rapidly, while others remain stable or even fall. Technology products, for example, sometimes become cheaper due to improvements in production efficiency. However, inflation refers to the overall trend in the economy. Even if certain goods become cheaper, if most goods and services become more expensive, inflation is present. Many people assume that inflation is always negative, but that is not entirely true. A small and predictable level of inflation is generally considered healthy for an economy. In fact, many central banks aim for an inflation rate of around 2% per year. Moderate inflation encourages spending and investment. If people expect prices to rise slowly, they are more likely to buy goods and services today rather than postpone their purchases indefinitely. This behavior keeps money circulating in the economy, supporting businesses and employment. However, when inflation becomes too high, it can cause serious problems. High inflation creates uncertainty. If businesses cannot predict future costs, they hesitate to invest. If workers cannot predict future prices, they demand higher wages as protection. This can lead to a cycle where rising wages increase production costs, which in turn lead to higher prices, creating even more wage demands. This process is sometimes called a wage price spiral. In extreme cases, inflation can turn into hyperinflation. Hyperinflation is an extremely rapid and out-of-control rise in prices. During hyperinflation, money loses value so quickly that people rush to spend it as soon as they receive it. Saving becomes pointless, because the value of money may collapse within days or weeks. In historical cases of hyperinflation, prices have doubled within days. Such situations often occur during severe political or economic crises, when governments print massive amounts of money to cover their expenses. Hyperinflation damages trust in the currency and can destroy an economy. Inflation affects different groups in society in different ways. People with fixed incomes, such as retirees receiving pensions, may struggle if their income does not rise with inflation. If prices increase but their income remains the same, their standard of living declines. Similarly, individuals who keep large amounts of cash savings without earning interest lose purchasing power over time. On the other hand, borrowers with fixed interest loans may benefit from moderate inflation. If someone takes out a mortgage with a fixed monthly payment and inflation rises, their wages may increase over time while their loan payment stays the same. In real terms, the burden of their debt becomes lighter. Lenders, however, may lose because the money they receive back is worth less than when they lent it. Inflation also influences interest rates. When inflation is high, lenders demand higher interest rates to compensate for the loss of purchasing power. Central banks often raise interest rates to slow down inflation. Higher interest rates make borrowing more expensive, which reduces spending and investment. As demand decreases, price pressures may ease. Conversely, when inflation is very low or the economy is weak, central banks may lower interest rates to encourage borrowing and stimulate economic activity. Expectations play a powerful role in inflation. If people believe that prices will continue to rise, they may change their behavior in ways that actually cause inflation to continue. Workers demand higher wages, businesses increase prices in advance, and consumers buy goods sooner to avoid paying more later. These actions can reinforce inflationary trends. Therefore, managing expectations is an important part of economic policy. Global factors can also influence inflation. In today's interconnected world, supply chains span multiple countries. If there are disruptions in one region, such as natural disasters, conflicts, or trade restrictions, production costs can rise globally. Energy prices, food production, and international trade all affect domestic inflation rates. No country is completely isolated from global economic forces. Technological progress can help reduce inflationary pressures. When companies develop more efficient production methods, they can produce goods at lower costs. Increased productivity means more goods and services are available in the economy, which can balance the growth in money supply and demand. Over time, innovation and competition often help keep prices stable. Understanding inflation is important not only for economists and policymakers but also for individuals. It influences how we save, invest, borrow, and plan for the future. When deciding whether to keep money in a savings account, invest in property, or start a business, inflation is a key factor to consider. Even wage negotiations are affected by inflation, since employees want their salaries to keep pace with rising living costs. In simple terms, inflation reflects the changing value of money over time. Money is not a fixed measure like a ruler that always stays the same length. Instead, its value shifts depending on economic conditions. Inflation is the process through which money gradually loses some of its purchasing power. While small and stable inflation can support economic growth, high and unpredictable inflation can create instability and hardship. By understanding inflation, we gain a clearer picture of how economies function. We see how supply and demand interact, how government policies influence markets, and how global events affect local prices. Most importantly, we understand how changes in the value of money shape our daily lives. Inflation is not just a theoretical concept discussed in textbooks. It is a real force that touches everything from the price of bread to the cost of housing. Recognizing how it works allows us to make more informed decisions and better prepare for the future.